Thank you, Karim, for this beautiful opportunity for me. And yeah, it's Patrick and Karim, and hello all of this who decided to join us today. Today we are here with Patrick Gouhin, and CEO of Angel Capital Association, and also Karim, and Chief Strategy Officer of Linqto. We are going to talk about angel investment and angel investing, which is the most important step of a startup to become a unicorn. So, Patrick, I want to start with you. Like, no question, you're a person with very important experiences in your career, really inspiring to me. International Society of Automation, American Institute of Aeronautics and Astronautics, and National Institute of Aerospace. And yeah, do you want to open little bit talk about yourself? And I have a couple of questions for you.
Okay, sure. So Cigdem, thank you very much for that lead in, and Karim, thank you to you and Linqto for organizing this event. So as Cigdem said, my name is Pat Gouhin, and I'm the CEO of the Angel Capital Association, and we are a professional society that is really the steward of the angel investment community. So we've got about 15,000 members, most of those in the US, and most belong to about 250 angel groups. And we really work with all of those accredited investors to identify the best and brightest entrepreneurs and startups to invest in them so that they can go on to be those unicorns that Karim has talked about, and really to provide economic growth, not only around the country, but around the world. So just to give you one stat and figure on that, mentioned that we've got 250 angel groups. One of those is in Arizona and called Desert Angels. About a year ago, they did an economic impact study. And what they found is that all the investments they made over the previous 10 years, that on average, every $100,000 invested led to $458,000 in jobs, 5.8 direct jobs, another 37,000 in local taxes and state revenue, and then 2.1 million in economic output. So there's a 21x multiplier there. And if you look at that same period, that one group provided 47.3 million worth of funding, so leveraged at 21x. So just think about the power of that, and that's going on in local communities across the US and around the world, and really feeding the pipeline for the VC community. So I'll stop there as an entry point.
Yeah, that's amazing numbers, actually. The association is the largest professional development organization for angel investors in the world, deploying more than, as you said, Pat, 650 million in early stage capital each year. It's really huge.
And actually, we just finished our most recent report. That number is now up to 950 million. So almost $1 billion annually. That's going into about 3,000 startups. That's coming from our members. And then we also estimate that they volunteer about 1 million hours per year in just helping to cultivate those entrepreneurs and really make sure that they've got the stage set for success and high growth in the future years.
Amazing. And Karim, you also play a critical role on Linqto. You enable Linqto to contribute to startups that have passed the seed investment stage and have received their first investment. How would you evaluate the evaluation of angel investing, especially for the Web3 space?
Thank you, Cigdem. So I actually have to say to Pat and Angel Capital Association and the whole team there, thank you for this opportunity. We've officially partnered together, and we will be working together intimately in 2023 and hopefully beyond. And this is really important. I've been an angel investor for almost 20 years. And as good as we think we are, there are very many holes that need to be filled. We support early stage investors, and Linqto was actually an early stage investment that I made in 2016. And all of these startup companies go through product market fit. And eventually we found our product market fit in 2019 when we had almost zero money left that we raised. But we were lucky that we found the right product market fit, and Linqto does a financial marketplace platform, creating liquidity in a very illiquid market. And we started a platform with Acorns and some unicorns, that is very early stage companies, and some unicorn companies that were based on a valuation of $1 billion or more that we acquired investments in through the secondary market. And we were very successful in growing that market very, very quickly. So in 2.5 years, we've gone from 3 employees to tracking 60 employees, from 0 revenue to member investments in excess of $175 million. All the companies that you see on the Linqto platform today, there are 25 companies. We've had 6 exits since 2020 when we started. But all of those companies that are on the platform, we're on the cap table because we've invested in these companies. But having a partnership with Angel Capital Association is very important because as early stage investors, we're always looking for the path that these companies can grow, acquire more funding, and then continue towards their road towards exit. So this is really important for us and the relationship for all that we do. So thank you, Pat, and thank you, ACA.
Yeah, and also congrats for the really important and crucial partnership with Angel Investors Association and with Linqto. And yeah, I want to back to Pat again. And I want to know like more closely, actually, like the thing I'm most curious about is what kind of responsibility do you carry on your shoulders as a CEO at the current time? And what has got you worried the most this year about your maybe investments or about the market situation? How do you say?
Sure. So because we do see ourselves as the steward of the angel investment community and the asset class, that does come with a lot of responsibility. And so we take that responsibility seriously. And what we try to offer, not only our members, but the community, are 4 strategic pillars that really define who we are and what we do. And that kind of starts with the membership component of it and networking and holding events. So just like this event where we share knowledge and we bring out the best practices. And then that really leads us into a formal educational program that we have built up in the past couple of years to curate the content and the best practices that we now refer to as Angel University. And we are teaching, it's up to 9 courses now all around the world to educate not only newbie investors, but also entrepreneurs too, so that they can get inside the mind of an angel so that when they are ready to raise, they know what it's like. Then we're also trying to bring out what I would call the science of angel investing and move it away from the black art or the gut feel or the early days. And we do that through data analytics. And we'll be talking, I think, a little bit later about our Angel Funders Report, which really looks at all of these investments and tries to get deep insights into what's successful, what's not, why not, and so forth. And then the final area is one of public policy. These are the things that we do to, again, protect the investor base and the entrepreneurial base so that we can keep capital flowing and making sure that entrepreneurs have the funds that they need to build these companies. So that's kind of where the responsibility lies. Wrapped around all that is another nonprofit that we created 2 years ago called the Angel Investor Foundation that has a Seed the Future campaign that's really focused on DEI and trying to bring the community together, because we like to say that entrepreneurs are the engine for economic growth and it's angels that are the fuel for that engine. And that seems to resonate with everybody. And so that kind of is the tagline that we use. But the final part of your question is, beyond the responsibility, what am I worried about? So let me just briefly touch on a few points there. Certainly the economy and what we've seen happen. We had a wonderful 2021. Look at all of the exits, the VC dollars that were there, but that really caused an inflation in the valuations and some indigestion that now we're going to have to work through as we go into a tougher economy, the remainder of 2022 into 2023. We expect that it will be tougher for entrepreneurs to raise funds, and really that the leverage is going to change from that of the entrepreneur to the investor. And so we think that, kind of the rules and the standards that played out in 2020 and 2021 during the pandemic are not going to be the rules of the game going forward. And it's critically important that entrepreneurs understand that so that they can work collaboratively with the investors to get the funds they need to grow these companies. Then in addition to that, we really have the legislative and regulatory pressures that I mentioned from a public policy standpoint. The Securities and Exchange Commission, at least in the U.S., controls a lot of what happens, in this space in private markets. And there's been a lot of discussion that could harm, that flow of capital. So we're working, very hard to make sure that we don't bite off our nose to spite our face, so to speak, on that front. And then finally, the area that we're watching closely is just that the investment game is changing. We're seeing more Gen Z professionals come into this. They are not their mother and father's investors. They want to interact differently. They see things differently. And they have not necessarily been through the same kind of downturn that some of the older generations have, economic cycles that we go through. So we're interested to see how that plays out over the next 18 to 24 months.
Thank you. And also, Patrick, it's like personal curiosity about you. And you have a serious experience in like aviation and like aerospace exploration, right? Like, how did you combine this experience, like maybe namely these two different disciplines with the investor entrepreneurial side? Looks like there is a nice glow here. And please share us, like, what was it?
Well, that's a long story, but I'll try and give you the condensed version of it. So by education, I'm an aerospace engineer, and I spent 15 years doing aerospace stuff. And then I got a phone call from a recruiter for a job. I was originally in Washington, D.C. area, and then I moved about 15 years ago to the Research Triangle Park area to run an industrial automation company. So, first career was aerospace, second was automation from the engineering side of it, getting into cybersecurity and things like that. And I did that for about another 15 years. And then I took a couple of years off and enjoyed my family and got my health back and started to eat better and all those good things, to the point where my kids said, "Dad, you should do something productive with your life." But I didn't really want to go back into the same kind of, environment that I had been in. And I happened to stumble across this opportunity with angel investing and the Angel Capital Association. And so I started talking with the search committee and the board, and I said, "Hey, I don't really know anything about the entrepreneurial community or being an investor or VCs or any of that. But what I do know is association management and how we can take 15 years of the startup mentality that we had and kind of institutionalize that and turn ACA into more of your typical professional society that's the steward of a community." And at the same time, that allowed me to get in the game, to make a network of wonderful angels, meet great people, see great entrepreneurs, and kind of give back as well as I was learning. So I like to joke that this is my third professional career, and I haven't even got out of the A's yet, because I started in aerospace, went to automation, and now angel investing. So that's my story.
Oh, thank you for sharing. I think it's really inspiring and motivator story. Thank you again. And let's Karim, and we all know the markets have crashed and markets have been doing not good this year. But in Web3 space, business developments and startup investments are like acting like nothing happened and are continuing like as before. As we are getting to end of this year, what did you guys do in Linqto? And can you talk a little bit with numbers? What happened exactly?
Oh, so there's so many points to that question. And before I get that, because those are relatively easier for me to do, but I want to acknowledge what Patrick said. A lot of what he said. There are about 5, 6, 7 talking points that he mentioned in his response, and I won't be able to get to all of them, but there's a lot there to unpack. Everything from Gen Z investing to the current market situation to what the future looks like, as well as some of the companies that are being developed and his background. There are a lot. So when you re-listen to this recording, I'd like to take some of those questions and respond to them, but that'll be later. But I do want to say that a lot of those things that were covered, especially in the space and Gen Z, we do have panels coming up during the course of the next 2 or 3 days that will cover some of those topics. But in terms of Linqto, what was like any other struggle, any other startup, there is, you know, the old saying, you've got to be at the right place at the right time with the right team. Let's keep in mind that that took us over 6 years to be in the right place at the right time, doing the right thing. The idea about any startup is sustainability. Can you survive the period it takes for you to be in the right place at the right time with the right team? Oftentimes, startups don't realize that the real talent after raising money, which is one step, the real talent is to identify and be there in existence at the right time. Both Patrick and I, and a lot of you other investors on the call, have experienced this. You found a founding team that has done a great job building a company. You're excited, you're enthusiastic, you've invested money in the company, but they run out. And 2 or 3 years later, another company pops up with the same business model, same idea, better execution, and they succeed. Why is that? It's because you didn't have the sustained runway in which to execute what you started with. And that is really the case of Linqto. We like I said, we raised money, we ran out of money, but we had the technology, we had a great team, and we sustained it and made the pivots quickly. Making pivots is important, quickly, to recognize that either the business model that you have is flawed or not appropriate for the time that your existence is. So quickly pivoted that and said, hey, let's just change this. And really, the team that you have around you, the ability for them to execute and get to the program, get on the program, is probably the most significant thing that can happen. A team of co-founders that will not run away when the money sort of gets diminished is also important. So recognizing the people that you marry in terms of this little business is important. The other point, so we were able to stick this team together, continue working together, and then execute on the platform and continually execute, because the first derivative of any business that you do often is not the best one. So I would say to any startup, it's invent your company, invent your business model, but keep reinventing during the course of the existence so that no one over invents before you. So the idea is to keep a very close eye on what's happening around you, and then continue to reinvent who you are and what you're doing. Make sure, the other thing that a lot of startups don't realize and should start to realize is that making money is important, right? Spending less than what you earn and not the other way around. If your revenue is $1 million, well, don't spend $1.5 million, because that's just digging a hole. I mean, that relates to business, it relates to personal finance. It's making sure that you spend what you have rather than not. So we have at our company, we have something called zero-based budgeting, where we do not spend more than we make. And if we don't have the money, we won't spend the money. So we'll just do everything that we can to make sure that we spend correctly. So that's why we've got where we've got. And this comes from many, many years of either being part of startups, investing in startups, and then realizing what's done wrong and what needs to be corrected.
Exactly.
In terms,
yeah, go ahead, please.
No, in terms of what we see in the marketplace, and startups are always being created. And one of the reasons we started, and I think what we have to be very careful, and Cigdem, this is why it's important that you're here and Patrick is here. And one of the reasons we created the Global Investor Conference as a virtual platform, because what happens is sometimes as investors and startups, the little world geographically contained, we think we're doing something that nobody else has done or doing around them, whether it's in Oregon or Seattle or Vancouver or Boston, New York, Taiwan and China, Hong Kong, Australia, and London, right? So the Global Investor Conference was created for this purpose. It was like, hey, let us get thought leaders, investors, and entrepreneurs from the globe who will speak to us during this conference about what they're seeing, what they're investing in, what they're building, so that we then get a perspective, and all of us as entrepreneurs and investors get a perspective of what's happening globally. So it's very important to look outside of our little bubble and look past that. And not to say that we shouldn't create startups that we're enthusiastic and passionate about, but we should realize what else is happening globally around us and not believe that we're insulated from other entrepreneurs and investors.
Yeah, I agree with you, and it's really important. And you said like sustainability. I think it's like I can highlight it, like sustainability and like revenue and spending control. It's really crucial. And thank you, all of this. Karim, I'm going to back again, Patrick here. And Patrick, you publish the Angel Founders Report annually to increase awareness about angel investor activity and build a deeper understanding of the investing environment. The report provides context for seemingly disparate data points and identifies trends and highlights innovative ways that your members are working together to fuel the entrepreneurial ecosystem. Would you mind telling us about the highlights of this year's report specifically for you?
Sure, I'd be happy to. And we just published this about 2 weeks ago. As you mentioned, we do it. I'm going to drop the link to it in the chat here. And so you'll all be able to access that. And this is based on US data, but we do have sister organizations around the world that are doing it in other countries. So if you happen to be outside the US, you might look to your local professional society to see if they have similar information. But what we have found is that in the past year, as I mentioned, those angels put about 950 million into roughly 3,000 companies or so. That was an increase from what we saw the previous year. We also came to realize that those initial investments by angels were leveraged at a 5x level. So that is to say that the portfolio companies went on to raise $5 billion. The average amount per group is about $5.3 million that they put into. And what we've seen is that the angels invested more dollars per company, but we did see a slight decrease in the number of deals that the groups invested in. And we think this is simply because of the pandemic and their desire to kind of double down on the investments they've made. They participated more in follow-on rounds than they have previously done. However, with that said, about 50% of their dollars did go to Series Seed, and about 60% of those were for new deals, which is up from about 50% from the prior years. I mentioned that diversity, equity, inclusion is very important for us. And that is something that we saw a nice increase in the past year for Asian CEOs who nearly doubled the amount, and Latinx CEOs that did double it. Where we were very disappointed is what we saw happen in the Black founder community. Last year, we had a wonderful increase. In fact, we were able to move the needle more than the VC community, and we had it up to about 15% of the funding. However, in this past cycle, that dropped in half. So still better than where it had historically been, not where we need to be, and we're going to challenge our groups to improve that. If we specifically talk about females, we are now seeing that about 30% of our investors are females. And that's very important because we know that the companies that they're invested in often models what the investor looks like themselves. We also have seen a nice trend in that 2 years ago, female founders were generating about 75 cents on a dollar to their male counterparts. Last year, it went to 93 cents on a dollar. And in this most recent report, it just cracked over the dollar amount, was $1.01. So female founders in this past year did in fact raise more than their male counterparts on deals. I think that really covers it, other than let me just say that health and life sciences have been increasing, and they've displaced the long time, kind of angel mainstays, which would be sectors like enterprise software, fintech, and hardware. But that link is in the chat box. There's wonderful information. It is free. Simply go there and you can see all those stats and figures and trends. And we really believe that we have the best data on the early stage investment, simply because nobody else is tracking with the number of deals and the accuracy, all of those, pre-seed, seed, and Series A rounds that ACA does. So I hope you find that valuable.
Yeah, thank you for the really important highlights and numbers. Patrick, let's go dive like startup lives. And Karim, what do you think are the most important factors that move a startup from acorns to unicorns?
Survival. So this is actually a very deep topic, and survival means many, many things. I mentioned before the ability to sustain changes in the market, to sustain market acceptance of who you are, what you do, to ensure that you have a revenue line that is that sustains your business and the growth of your business. Those are important aspects of survival as an acorn, right? If you can't do the revenue, understand the market, and have a great team that can iterate on the product, you will be an acorn for a long, long time that is still under the ground, which a little bit of growth. But as we see your company start to grow, here becomes another critical issue. Is how do you manage the growth? And by that I mean there are different characters within the organization, different strengths and weaknesses within the organization that have to be managed to or for. As you change, you have teams. I have investments that are great opportunities. There were great opportunities 5 years ago. There were great opportunities 2 years ago. But as an example, the founder said, "Hey, I need several $100,000 to change the technology platform that we're using." What does that actually mean? It actually means you have to raise significant capital. It means you have to look at your technology team at that point, that critical juncture of all of a sudden I need a different, more robust technology platform that the original team I had cannot build on or towards. So I've got to change that. So not only do you have to raise money, but as a founder and a founding team that you were together for 5 years, are you comfortable emotionally to make that decision to let go of that founding team? to actually go into this area of uncertainty and learn something new, give up your old team, learn something new, and face a risk that you might fail with the new technology, but you well know that the old technology that you're using is not going to function. That's just one. The second is if you look at what the current situation is with employees, and how the pandemic created an environment where it is a distributed employee base. We've been so used to for decades of everyone coming into the office, looking at them, watching them, having conversations with them, having coffee and socializing. That is so important because it gives you a perspective physically of how your colleagues and employees are doing. Are they functioning well? Do they have questions that you can respond to? Do they need mentoring and coaching? Are they executing on their deliverables? And these happen in the office on a day-to-day basis. Now, with even at the first point that you started with this distributed workforce, even though you may still be in the same state, you don't see them anymore. You don't know what they're doing. You don't know what they're going through. What we see in Zoom is entirely different from when you see them in real life. I mean, I'll stand up and I'm still in my pajamas, right? How would you know that, right? So the psychological motivational factors that we don't see happening in this distributed workforce is critical. And in 2 years, we saw a lot of failures. In the last 2.5 years, we saw a lot of failures because people couldn't manage that. And not only for the entrepreneurs themselves who built the startups, but the employees. We hear of employees all the time saying, I really enjoyed working in a space with my colleagues because I was more productive. I was more engaged. I was more fulfilled. I got out of the house. I didn't have to deal with certain things that are at home. Well, those employees are not being productive at home, right? Other employees are saying, I remember the days that we shut our offices in San Francisco and says, okay, everyone needs to work from home. And the first reaction that went through my mind was, wow, amazing. I will not have to commute 2 hours there, 1 hour back, worry about parking, finding where to park and eating junk food. It's going to be amazing. I'll have so much more time to exercise and do this and do that and all that sort of stuff. But the fact is, today, I spend more time on conference calls than I would have in meetings at the office. And so how does that affect me, right? So psychologically, emotionally, physically, that's taken a toll. Your 8 hour day that you thought you were saving 2 hours is extended now to 12 hours being available because you're at home or work from home or work from anywhere. That's one issue. The other issue is, let's look at it. So you've got other companies saying, this is wonderful. What I'll do is I'll get some highly leveraged employees in terms of cost efficiencies in different parts of the world with different talents. I mean, in San Francisco, an engineer in 2018, 2019 a starting salary was over $350,000. Well, maybe I can get that engineer in Utah or in India or in Argentina for 150. Well, now you've got to deal with language barriers, work morale, time zones, health insurance, governance, equity plans. You've got all of these things starting to play into an environment of business that you never anticipated. So all of a sudden you had two reasons. I'll get better or more diversified, more economical colleagues, but you've added a bunch of infrastructure issues that you never thought possible. It's not easy getting an employee in London. It's not easy getting an employee in Ireland. They have different problems there. I mean, we've got HR problems. We've got employee options. I mean, all of a sudden we're used to working in California. We all take, maybe in a year, we take 2 weeks off. Well, if you're in Europe, the mandate is 8 to 12 weeks that you get off. Now, all of a sudden, you've lost 1/3 of your productivity or 1/4 of your productivity just with mandated time off. So how do you deal with these things? So as let's remind ourselves, acorns to unicorns, sustainability, growing, profitability, challenges that we've seen in 2019. Well, we're in 2021, right? 22, flowing very quickly to 23. We thought 6-9 months ago, the pandemic was over. That's what we started to believe. We started getting people back in the office. And we said, hey, you need to do this, you need to do this. Well, guess what? If you look at the numbers today, RSA, the flu, a variant of the COVID, it's coming back. The hospitals in many places are full and overflowing. What does this mean? So not only the original challenges of growing a company to become a medium and then a high growth and then a unicorn company, but we've got these global environmental challenge and economic challenges now that are playing into these factors. You've got the interest rates, you've got the meltdown in the market, you've got the meltdown in the crypto environment, you've got all of these things that are happening with new technologies that are emerging very, very quickly because of blockchain. You've got businesses that are building more efficiently, more productively on technologies of no code or low code. That is legacy companies you spent millions of dollars to do. If you raised money 5 years ago building on a certain technology platform, you've got the same company being able to develop that on no code platforms today for almost nothing, right? So you've got to worry about that. And then you've got to get to, okay, now I'm growing. Here's the problem. It's easy growing from 1 million to 2 million revenue. Still same group, same team. You're still exploring the opportunity in the market. You're growing from 2 million to 4 million. Okay, same team, same technology. You're still exploring the market. And then what happens when you plateau at revenue levels of 10 million? Now you've got a whole bunch of challenges. Can your team build? What does your marketplace look like? How do you invest in these companies? Where do you get the funding from? Are you generating revenue? Do you have to raise some more money? And in today's environment, how easy will that be? Let's look at what has happened with the FTX meltdown, right? All of a sudden, you've got like venture companies, like Patrick was saying, oh, wait a minute. I don't know if I can invest in you anymore. I don't know what the valuations are. So you've got the growth plan, but what are the revenues based on your growth plan? How do you do this? How do I value this? What's the due diligence on this? Why should I be investing in you? There are like hundreds of companies all across the globe developing something similar to you. So you got to worry about this, right? And then add to this, it's like, am I sure I'm not going to lose my money? Is there something there that I'm not aware of? And I would like to add to what Patrick was talking about, was like when you do due diligence, when you're raising money, you're based on some static figure. I'm thinking that this is my business and my revenue models today. I project that this will happen in 6 to 12, 18 months. And therefore, I'm raising money today at a valuation of X dollars for an implied valuation of another X plus dollars on a static data point. My contention today is that what we need to have is something that's more dynamic, and I'd like to call that dynamic diligence. How do we, on a regular basis, understand how, as a company, we're doing internally? So on a regular basis, make sure that we are dynamically understanding our numbers. And then as we continue to grow, be able to project that if we're raising money, or if we're going for the next round, or if we're heading towards a public an exit, whether it's through an MA or an IPO, dynamically be able to understand what you're doing and what the investors can expect from you. In addition to all these fundamentals, the biggest problem is this that I see. The transition from a large, let's say, $50 million revenue company to a $100 million revenue company, the dynamics are entirely different. What you need to be able to do changes fundamentally for any company. And that's the biggest challenge. So it's nice to say I'm a unicorn, but that's based on a valuation. It's just an arbitrary number. I'm based at $1 billion. What does that really mean? Does it mean anything? The only thing it means is that you successfully raised money at a higher valuation. Does it mean that your company is fundamentally sound? And that's the question we have to ask. So I wouldn't say being a unicorn is the criteria for success. Looking at everything that goes towards generating revenue and profitability sets you up for success that's appropriate. So let's not think about it as valuation. Now, we can say, oh yeah, with this VC did a great, they're willing to pump X dollars at this valuation. So what? We've seen what's happened. It means almost nothing today. It'll mean less tomorrow. But I'm not saying it won't change. As soon as exuberance comes back in 3 or 4 years, after we've settled through this dust, we'll probably go back to that, and all of a sudden we'll be talking about unicorns again. I think what we have to look at is fundamentals of the business and not worry about the terms.
Karim, you mentioned really important things, and it was a really good speech, by the way. And also, like Patrick, and I said, like Karim mentioned about every single important things about this, like most important factors that move a startup from acorns to unicorns. I would love to get your opinion on this matter too.
Yeah, so I thought he communicated that very well. Let me distill everything he said down to 7 bullet points that I wrote down here. And keep in mind, from the angel perspective, while we all aspire to have unicorns, we're at the very beginning of that journey, right? So, and I think he hit on all these points. Are they properly capitalized? Have they properly set valuations and deal terms to attract investors at each stage? Does the CEO have the management team and experience they need to drive growth, realize opportunity, and pivot when required? Have they found product market fit? Do they have proper IP protection? Are there barriers to entry for competitors in their sizable, competition that they're going to see? And are the founders thinking about future rounds and what that exit strategy is? Because that's the only way that angels get paid. And I think what Linqto has to offer helps in many of those areas, but specifically the new opportunities associated with later stage investing and a secondary market. So I hope that that's a quick response that kind of takes what Karim put out there and wraps a bow around it.
Patrick, thank you. It does.
Yeah, it was a good complimentary, actually. Thank you, like Patrick and Karim. These are really important for entrepreneurs. Like, still maybe they're like investing stage or like Series A stage or like going to the unicorn is really important. So what was the last things, like future goals in the next year as we close the last quarter of 2023? I want to talk about our future goals next year. When you think about your like organizations and your work, what was the thing you had no regret about, given the chance you will do it all over again? And what is the one thing that you will never do in next year?
Which one of us are you asking first?
Please go ahead, Patrick.
Sure. So, let me kind of spin the question slightly to say what impressed me most about, the past couple of years that I think is going to have a lasting legacy. And that is that, kind of going into the pandemic, when we first had to deal with that, most of our angel groups, the great majority said, oh, all of our deal flow and the meetings we have, it's got to be face-to-face. There's just no way we can do this virtually. Well, guess what? That was taken away from them. We started to do things with virtual meetings, virtual presentations, and I think to a lot of people's surprise, it worked. We got comfortable with that. We figured out how to make it work. And so then the natural follow on to that was, well, wait a minute, if we can do this virtually, why should we only be looking at deal flow in our backyard? And so I think there has been a movement where angel groups have begun to expand the radius of the geography for which they look for good companies. And I see that continuing. Tied very closely to that is syndication. And then angel groups said, well, gee, if we're kind of going out a little bit further, maybe we should be a better neighbor to whoever that next angel group is. And maybe we should share deals and, let's build the trusted network. That's going on around the country. It's helping entrepreneurs fill out rounds more quickly because when they find that lead investor often goes forward and then represents them and says, hey, we've got this great deal, great terms. You should take a look at this company. And so that really, I think, is a positive that helps everybody out. I can stop there. If you want me to ask or answer the second part of your question, I'd be glad to do that about things to be cautious of moving forward.
So is there any project that you've been like an angel investor of, any startups you have invested that are close to becoming a unicorn?
Well, for me, the answer to that is no, but it's simply because it's been 4 years that I've been doing this, and we all know that this is patient capital. It takes a lot longer, and simply by the nature of our activities, we're looking at the pre-seed, seed, and Series A companies. So many are progressing nicely, but are they anywhere close to a unicorn? No, but this is a wonderful, opportunity where I think others that are in my situation or other angel groups can look at a partnership with Linqto to say, hey, that's not the typical kind of company that we like. We all care about diversity of all kinds. Well, this is an opportunity to work with Linqto, look at those companies that perhaps are further along, that have higher valuations, that overall will give us a more rounded and more diverse portfolio that should generate better returns and sooner.
Okay, what about Karim, and which startup managed to raise the most investment on the Linqto platform, and what do you attribute this success to?
I want you to ask this. I want to answer the same question that you asked Patrick. Let me say this first, Patrick. I thank you so much for that. So one of the major reasons that Linqto and ACA are working together is because we understand that there are different opportunities for investors, right? So being able to invest in an angel and support them and help them grow is important, which I've done, Patrick has done, and so many of you on the phone has done, on the call have done. But being able to actually invest in companies that are not available to ordinarily any angel investors is what we're building, which is the ability to invest reasonably on a mid to late stage growth company, which is not available or hardly been available at an entry level to anybody globally. So one of the ideas is to allow angels to do this effectively, quickly. Once you get onto the Linqto platform, if you've already been accredited, you can get onto the app, click and invest in any company or 10 companies. And we see a lot of that happening now, is like investors are saying, you know what, I've got X number of dollars, I've got $250,000 to deploy. Instead of buying one company, I can deploy that across 10 companies, which is important. And we're seeing a lot of that happen. But the other thing that is really important is when I was an angel investor in companies, as soon as we raised the angel round and the company was developing, we were always looking, again, we started to look for money. Where now am I raising the B round? Where am I raising the C round? And so that's when we come into play at a certain point in the company's valuation. Is like, okay, Linqto exists for founders, executives, early stage investors, ex-employees to find liquidity. So if they want some cash that they've completely tied their hands around and they need some liquidity, we're there to provide it, provided that company fits the obligations, right? So you can be an angel investor for a long time in a company, 5 to 6 years. You initially invested at maybe 10 or 20 cents valuation, right? By the time they've successfully raised their second, after pre-seed, they've raised a seed and they've probably raised their A, that valuation that you've got is probably already 50x, right? So if you put in $25,000 or 100,000, your valuation of that company and what you can get returns on is significant. So as an early stage investor, you can say, hey, I can find liquidity on the Linqto platform by redeeming some of my shares or selling some of my shares in my to the Linqto platform. That's an important aspect as well of the relationship moving forward. Also, it's important for us to keep track of what the ACA and their angel groups are investing in, because we've seen with the emerging technologies and the markets that they're addressing, valuations sometimes can jump very, very quickly from the A stage of 10 million to 100 million in the B stage because they've found a product market fit and they're growing globally. And we want to make sure at that time we know who these companies are. We may not invest in the A round, but we'll definitely look at the company as they're starting to progress towards their B round, right? So it's important for us to be able to keep tabs and a relationship with the founders of these companies. So in terms of what we've seen happen successfully, companies investing that are doing really well today on our platform that's available would be a company called Ripple. They're doing significantly well. So we've invested a lot of money there. We've seen a company called Polysign that's doing really well, and the CEO of Polysign will be on one of our panels later. We've also seen, so when we look at infrastructure companies, we've invested in Blockdaemon, a blockchain infrastructure company. We've invested in, when we look at NFTs and that infrastructure, we've got companies that we've invested in called Dapper Labs, a lot of investors in Dapper Labs. And then we brought on 4 new companies this last week, including Alchemy, Rippling, I forget the name of the gaming company, but it's there somewhere. So all of these companies, depending on how they're progressing, will take investments at certain levels. So if they continue to progress well, we'll continue to invest, and these are dependent on the secondary shares available and the price points and the valuation. We'll make decisions when we can on those companies. So all of those companies with the data sheets are on our platform today.
Thank you, Karim and Patrick. Also, so we are coming in the end of our session. And lastly, I want to ask, what would be your New Year goals, messages to startups, founders, and employees? Maybe startup employees also listen to us today. I want to just let's encourage them for a whole year.
Yeah, I don't mean this in a negative way, but I would say prepare for the worst and hope for the best, meaning that our advice is simply to, if you're in a raise now and it's oversubscribed, take the additional cash. You're probably going to need it. Do what you can to watch your run rate, because that can get you in a bind. We do expect capital to be more challenging in the next 18 to 24 months or so. However, those companies that are strong, those companies that have taken a proactive position, that have identified that product market fit, and that have negotiated realistic valuations, we think are going to get funding, and we think they're going to do well. I think the thing you need to be cautious of is down rounds later. So those that had wonderful valuations in 2021 that didn't raise in 2022, we suspect a lot of those earlier stage companies are going to have down rounds in 2023 or 2024. They won't have the cash they need, and that's going to be challenging for them to push through. So if you're in that position as a founder or CEO or senior management, do what you can to preserve capital and make sure that you've got cash on hand and that your burn rate is low.
Thank you, Patrick. That's what you've talked about startups. I would say to the individuals, what is really important today is that we're all here. We're healthy and we're able to do this. In 2023, just look back on your lifestyle and your beliefs and your motivations, and whatever you've done then, let's get better at doing that in 2023. If we are positive about who we are, where we are, and what we want to achieve, build a great healthy lifestyle around that, then 2023 will be fine. It'll be okay. It'll be fine. It'll be great. Just let's reimagine what we want to look like in 2023. And if we've got a positive attitude, it'll be great.
There are certainly going to be opportunities out there, lots of them. And remember, we believe that the leverage is moved from the entrepreneur to the investor. So that should be good valuations, good terms moving forward. It's an exciting time.
Exactly. And also, like, it's important to create like possibility for opportunities and like keep working. And thank you very much for your really valuable participation, Patrick and Karim. I'm delighted to have been able to moderate this panel. I hope you enjoyed it as well, like 100 people listening to us today. And you can follow us, Patrick, Karim, and me on our, and also Linqto and also Angel Investor Associated Twitter and LinkedIn pages. And also your feedback will be appreciated. Thank you all.